Hi, you're listening to Avenue Insights. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome to Avenue's Q1 podcast. We're just going to go over the quarterly report and give an update on where we see the investment world. I mean, it's incredible how fast things are moving, and just affirm where we're at and where we see the world going. So I'll throw it to Bryden. We're going to try this a different type of podcast this morning, where we're just in different locations. And Bryden, where do you feel that the portfolio is set for the next coming quarter?
Yeah, it's a good question. I think one of the things that we tried to highlight in the quarterly letter that just went out last week was really, I think, our view that the portfolio and this, in some aspects, the market broadly is really now in a sweet spot for the next several months as we enter what we expect to be the reopening of the economy as we're going forward over the next couple of quarters. And so I think we try to highlight this in the last couple of letters as well, just highlighting really the core type of companies that we traditionally look for as part of our portfolio. And it feels like the market is now coming back to a lot of these consistent, profitable companies from different spectrums of the economy. And I think from that perspective, I think that's changed from what we saw a year ago, where, and we've talked about this previously in other episodes, but I think the investment world has become very focused on sort of short-term thematic sectors to really focus on. And so if you remember, a year ago, it was all about the stay-at-home or the pandemic portfolio, and that was, all anyone could talk about for several months. And then as we got into the summer, the focus was in on the reopening portfolio, and then into the fall, it was the cyclical portfolio, and then into January, it was the SPAC and high flyer momentum portfolio, and all of those things have sort of gone through their phases. But at the same time, we're now coming back to this period where the market has come around to a lot of the core companies that we've liked for a long time. And so I think from that perspective, with where the market is and the portfolio is right now, I think we're very optimistic for for the balance of the year as we head through the summer. And I think from a portfolio construction perspective, I think we're very happy with how a lot of the companies that we own are responding. I think one of the other things I guess I would throw back to you on is there's a couple of key messages that we really tried to hit over the head in the letter this quarter. And so what would you, in a short summary, what would you summarize for investors and clients about some of the key things that you think are most important with the current setup that we have right now?
Yeah, I loved how you were just giving that brief summation of themes going through the market, and again, reading a newspaper, listening to media, it's getting incredibly complicated. And I love the throwing out terms like SPAC. Like, we could do a whole podcast on what SPACs are, why we don't do them, and again, these are ways of just bringing companies public. But it's a whole new little craze. And the worst problem with the stock market is you always feel like you're missing out on something. Your next door neighbor is always getting rich on some new trend, and why aren't I doing this? And just sort of going, that is always going to happen. That is what the stock market's all about. It's also going to happen when everybody's really negative. Some crazy trend comes out of it and goes, takes money in different directions. And I think it really comes back to, and that I'll bring it back to this quarterly letter, which the main theme was going back and assessing what did we do over the last year. This time, we're now in April, but in March, April last year, how dark it was, assessing, okay, businesses are closing down, where's the economy at? And really there's all sorts of different decisions that could have been made and the way to come out of this. But the single biggest issue is, how do you actually stay invested? And if it was to stay on the sideline or be too cautious, we've now seen that the stock market has gone so far from where we were this time last year. There's just a massive opportunity cost if you were on the sidelines, almost to the point that you just can't get back that rate of return. And so this is the hardest thing about stock market investing. And it's really to hit that point over the head. And we just try to put to, it's not really about, here's the portfolio today, and this is what we think the world is going to be in the next 3 months. It's just to do another, summary of, these are the 4 key principles of Avenue's strategy. And really the overlying principle is, how do we create a portfolio that keeps us invested and keeps us in the market? And it's being in the market over time, 5 years, 10 years, 20 years, that where the income compounding comes from, and being nervous about sort of saying we're in the latest little trend and we got to hop from this trend to another trend is what we're trying to avoid. So coming back to this theme of this, the bird in the hand, which is, if I have a great consistent business now, we would like to value that in the portfolio, as opposed to, here's going to be a great company in a couple of years' time. It's going to make tons of money, probably, but we don't know for sure. And when interest rates are really slow, when interest rates are really low, the stock market's willing to give a high valuation of something that's going to happen in the future. And now that interest rates are ticking up a bit, you've got much more value to companies that are making a lot of money now. So make sure all our companies are making money. It sounds simple, but that's not really the way the stock market works for the most part. And then whenever we're starting looking at a company for the first time, or securities analysis, is what's the downside? How can we build a great stable group of businesses that have limited downside? Upside can take care of itself, and then balance. And such a great point that SPAC investing, environment, ESG investing, all these acronyms are out there, but how about we have balance across the portfolio? It looks like technology is doing really well, but you still have to have your infrastructure, your real estate, and we're getting much better values in different parts of the portfolio, and they will all work together, protect us. And then the greatest innovation that we've had over the last year is really trying to, promote to all Avenue clients that the equity portfolio has an overall hedge on it as well. And it's really building a distinct strategy that we can bring to stock market investing.
Yeah, and I think on the last point, I mean, I think what's very interesting, is that even with the market and stocks being where they are, it still feels like there's an overall general level of sort of anxiety and nervousness, and you're hearing more and more people talk and feel like we're in a bubble, which obviously then people go back to what their historical reference point is, and is this the same as 1999? Is this the same as what the market did in the 80s or in the housing boom, in 07, 08. And so I think there's a lot of that sentiment starting to creep into the market psychology as well. But I think, and the one point you touched on as well, maybe we can highlight is, with interest rates rising in the last couple of months, the bond market, I think the stat that I saw, the bond market had the worst quarter since going back to 1994. So you had not only people that maybe got out of the equity market a year ago because of what was going on and all of the, what was going on in the economy and in the market and society at large. But you also had a lot of people over the last several years hiding out in the bond market, which now have just, had a bit of a tough quarter. And we're just starting to see significant outflows, from bonds as well. So maybe speak to that, as well as how we've worked to balance people between bonds and stocks. But the backdrop with rising interest rates, I think, is really now starting to come into the forefront for people that have been in the bond market.
Yeah, this has been an extraordinary quarter, and just to highlight the Avenue bond portfolio, which is mostly focuses on Canadian corporate bonds and a shorter duration. So when the overall bond market, which has a lot of governments and longer term bonds, it had a very bad quarter. And so in the Avenue portfolio, where we got extremely defensive, and we were down about 0.5% in the first quarter. And we actually look at that as a very big win in bond market investing. But it's hard to get excited about the bond market. But now, as interest rates have tipped up at least a sort of percent, it's not terrible. So we're incrementally more positive on the bond market. And we really don't think that interest rates are going to rise all that much. They're sort of capped because this idea there's just too much debt out there. I think we'd like to do another podcast and just sort of talk about the technical aspects of inflation. But I want to throw it back to you, Bryden, because you did great work. February of 2020, over a year ago, of pre-pandemic, of sort of saying, what was the state of the economy? And it feels like, although you expressed the point that there's negativity in terms of investors, but really, what is the overall framework that we find in the stock market right now?
Yeah, I think what's interesting is we're now in a window of opportunity or window of time over the next, say, 6 months, where I think all expectation is that the economy is going to be incredibly strong. Even going back to the potential to have as strong of economic growth as I think the 1983 or 1950 are the 2 years that are that are potentially the last couple of highest years. So we could have one of these just ridiculously strong economic periods of time over the next 6 months. But the other side of that is, and we were just talking about this prior to jumping on here, but there are still a lot of clouds on the horizon farther out beyond this current shorter term window where the economy is really strong. And so whether you look at the amount of the debt that has been pumped into the system, both at the government level, you've seen record issuance of corporate debt. Normally when you go through a recession, you have a lot of restructurings and bankruptcies that happen that are supposed to help unproductive or unprofitable companies sort of go away, and then that capital gets reallocated to other more productive companies or businesses. But that hasn't happened at all. So we now have even more debt across the board, and at the same time you're seeing talk of rising taxes. You're seeing obviously a lot of input costs have risen significantly, which I think over the next year will start to hit profits. And so it's almost like the tale of two cities. It's the tale of two worlds, where we're in this shorter term window where everything looks as good as it can possibly get, but a lot of these longer term issues are still hovering on the horizon out there. And I think why we think building a portfolio that can allow you to be invested through the whole period, or for long periods of time, is because it in some respects it feels like we're on the train being the market, and the market is moving. And so to not be positioned and owning businesses right now, I think would feel uncomfortable. But at the same time, if you're all in with no protection, that also would be equally uncomfortable. And so we're trying to come up the middle with the balance of not only what we own, but also having our tail protection on at the same time. So I think the setup right now is very positive, but I think a core part of our focus is always what are the longer term, bigger issues out there, and are we paying attention to them and aware of them, so that we're putting in place the decisions to sidestep those. But for the time being, I think things are almost as good as it can get.
I don't think there's a better way to say that. So why don't we end on that note?
Sure. Yeah. Why don't we wrap it up there? Thanks everyone for tuning in, and we'll be back hopefully soon with another episode with some more content for everyone.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.